We live in a world where there are several moving parts. As we speak, there is a war in Eastern Europe and there is a war in the Middle East. Not to mention of the countless economies around the world that are going through turmoil and the hundreds of central banks around the world working in their own tandem. Within all this, the economies and markets are working their way through. And in all this, how do we as investors make sense and at the end of the day create wealth? How do we deal with the ambiguity that's thrown up out of all this? That's what we're going to discuss in today's video. There are two components that come to play in every investment journey that an investor makes. Those components are risk and uncertainty. Let us understand both these terms a little bit more easily. I'm going to take an example. Let us assume you have two boxes on a table, box A and box B. Box A has 100 balls in it. It is equally divided as 50 white balls and 50 black balls. In the second box, which is box B, you have the same 100 balls in it, except that you do not know how many are white and how many are black. Now let us assume you were asked that without looking, closing your eyes, you had to put your hand into one of those boxes and pick out a ball. And for every white ball you picked, you got 500 rupees. Which box will you put your hand into? Yeah, absolutely right. Most people will think like you and go for box A. Box A is the choice because you know at least once in 2 times you will get the white ball. There's a 50% chance. Whereas in the other box, it's uncertain. Now let's reverse this a bit. In exactly the same scenario, let us say for every black ball that you picked, you got 500 rupees. Which box would you choose this time? You'd be surprised that everybody again chose box A. It seems ironical that if I have 2 choices and for one choice I chose box A, then it always usually means that for the next choice I would go to box B. But in this scenario, every contestant chose the same box A. Why? Because in box A, you are sure that there is a probability and there is a certain ratio by which you can derive your returns. Whereas in the second box, that is box B, there are no such conditions attached to it. Now, what does that tell us is that we are far more comfortable where risks are known than where there are stuff that we have to deal with uncertainty. Uncertainty is a big no-no for most of us. That includes all investors around. How do you tackle uncertainty? That's really the question that begs all of us. If in both the instances you have chosen box A, don't worry. So did we. In fact, most of us have gone with the more certain option as compared to the uncertain one. And this is actually called the Ellsberg paradox. Risk is when you know the probabilities of outcomes. Uncertainty is when you have no idea of any of the probabilities of outcome. Risk is reasonably easy to manage, so to say. There are statisticians, there are experts that will give you the odds of something happening or not happening. So to that extent, you can build up a protection or a system. Uncertainty is when no data is available to you of what can happen. Therefore, it is far more difficult to work with uncertainty. And in uncertainty, people will move towards actions that they are familiar with rather than what meets the objective. Now let's see a real life scenario of investments that may play out. Let us say, for instance, the stock market for some reason reacts to a big warlike event that escalates, say, either in the Middle East or in the Eastern European place where it's already happening. And the stock market takes a very, very big cognizance of it, and globally stock markets take a tumble, let's say 10-20%. What do you think most investors would do? In the face of uncertainty, most investors would like to sell their holdings and exit equity market. And this, when done together, will further exacerbate the whole market fall even further. Because that's what people do in uncertainty. While there is no clarity of what the outcomes are likely to be, people would prefer to choose what they're familiar with. So in times of crisis, maybe it's better to hold cash. Even if it were a wrong decision, they prefer to go with the crowd. They prefer to go with what the other fund managers or other experts are doing at that point in time. How do you and me as retail investors face uncertainty and volatility in stock market? I'd like to start by telling you a small story. In the early days of the Vietnam War, Admiral Stockdale, one of the highest ranking defense officials of United States, was captured by the enemy. He was then subjected to brutal torture for 8 to 10 hours, not for a day, not for 2 days, but for 8 long years. For 8 long years, Admiral Stockdale was given an inhuman treatment and survived in the worst of human conditions, but emerged at the end when the war got over and survived. In an interview that he was asked later as to how did he survive 8 years of torture, inhuman conditions and captivity, while other soldiers less than half his age and much more stronger perished in a very, very short period of time, Admiral Stockdale answered as follows. He said, "The day I was captured, I steeled myself and I told myself that I am going to be subjected to the worst kind of torture that is possible that man has ever faced. I anticipated it. I knew this was coming. And every morning as my prison door opened, I again said to myself that it's going to be bad this day. And I suffered and I suffered and I suffered. But unlike my younger compatriots who came into the prison believing that they would be free by Christmas or New Year, so they kept believing that this war would end by Christmas and they would be back with their families by New Year and so on and so forth. And when that didn't happen, they became depressed and they were in even greater pain. That ultimately led them to lose their lives. I had no such thing. I was a realist. I believed that the torture will go on and on. I made friends with pain and agony, he said. However, he also said, I had hope that one day I will gain my freedom and I will be reunited with my family. That kept me going even in the worst of days. That the desire to be reunited with my family was very strong. And that was the reason I survived so long. This seemingly paradoxical emotions of realism of brutal torture coupled with the hope that one day one would be free are two very powerful emotions we as investors can carry, my friend. On days when the stock market is plunging down, it's down 10%, 15%, always remember that it is brutal. That is the reality. That is how stock markets behave. Understand, stay in that movement. But also have hope that after all the dust is settled, know that you have invested in an investment asset class that is based on an economic growth that is growing at about 7.5%, will continue to do well, one of the leading economies of the world. Even if it falls down tremendously, it will find its way back up. Because at the end of the day, stock prices reflect the economic growth of either the country or the underlying company's growth. So it cannot remain down for long, it will come back up. So this realism of the plunging of the stock market, coupled with the hope that someday the realization of stock market will happen, and as an investor, you have committed yourself to staying invested in the long term, say 3 years or 5 years or 10 years, as the case may be, as per your financial goal, I believe is the secret sauce for creating a great amount of wealth for you in the long term. If you cannot be through the difficult days in stock markets, you don't deserve the great wealth that comes with it as well. And that's how, my friend, you deal with ambiguity relating to your investments in stocks and mutual funds.